Welcome to this edition of Immersive Outlook. We have with us Joydeep Roy, the India Financial Services Advisory Leader and Global Health Insurance Leader, in conversation with Varun Dua, founder and CEO of Acko General Insurance Limited.
Good afternoon, Varun. Good to have you with us.
Great pleasure to be here.
Varun, I must say I'm extremely happy in the way I think your whole journey has been. Having known you for over 2 decades, we've seen you from almost the start of your career, and the passion that you have brought into being single-mindedly focused on creating value. How do you feel about this?
No, it's Joydeep. We've known each other for a while, and it's been a long journey. I think my early learning days at Tata AG got me really close to the space, and over a period of time, you don't typically tend to get attached to a domain like insurance, but I definitely did get attached to a domain like insurance, and I think over the years, just the attachment to the space, more than the word passion, I end up using the word attachment, that we could do this better, there are better ways to solve it, and I think one thing led to another. So like I always say, this has been one journey for me, from being an employee to a software services provider to this industry, to trying to sell different products, to now doing our own products. So yeah, been a long journey, but exciting, and I continue to remain as attached to the space as I was many years ago.
Yes, at a time when people never believed that the youth of India would get attached to insurance. I think you saw the whole market, the protection gap, the whole gap in efficiency, and I've also been working with you across all of those phases, the Glitterberg phase, the Tata AIG first, then Glitterberg, then of course CoverFox, and now Acko. So I think that's what probably makes you and the entire string of journey unique. What do you think about this protection gap? Everybody's so upbeat about the protection gap providing a very long runway and growth potential. Is it all that hunky-dory?
I think I have, personally, over the years I have mixed emotions about whether this protection gap exists and there's this vast landscape for us to capture. I think a couple of things that have happened over the years is, does the protection gap exist? The answer is yes. It hugely exists. Even I don't quite believe that the numbers that we say even on life insurance penetration in India, or when we measure it against GDP with the kind of products that our citizens have, which is mostly savings products, the way we are measuring it, the protection gap is probably even larger than what some of the numbers represent. I think the challenge for us as an industry is that we are saturated in the top 25, 30 cities, maybe 50. And then the awareness levels and our ability to get to the tier 2, tier 3, tier 2 may be okay now, but tier 3, tier 4 rural is very different. And somehow today we still as an industry haven't found that magic wand in terms of cost structures and products to be able to reach that. So I think the protection gap exists, but we'll need newer models or more focus. I would say even a company like ours is not focused there today. Today we're still focused on the digital population, already savvy, already aware, and we're seeing that it's harder for companies to go down that road to tier 3 and create that awareness and go to rural markets. Frauds are rampant, so you really need to have a very high degree of focus to get there. So while the gap exists, I think we're still scratching the surface in terms of finding solutions. And I do strongly believe that you'll need companies who are specifically focused in those areas, and you're not going to be able to do everything from running a tier 1 insurer to a commercial insurer to doing product innovation for SMEs, to also catering to tier 3 India, rural India. We'll need specialists. I don't know how we get there, but that's what I feel.
That's very encouraging in fact, and I can see a lot of private equity interest now in the market, which was not there earlier. You were the first one of the first private equity invested companies, but there's a lot of interest in the sector, the PE sector. So what do you think about it? Do you think it's going to sort of advance this agenda of filling the gap? And what are the challenges of private equity investments in insurance today?
I think from my interactions with the investors over the last maybe half a decade or so, they're very bullish on India, very bullish on the insurance sector. They look at it as a sunrise sector. They look tremendous potential for growth over the next maybe 2-3 decades, and not just short-term growth. It's already a large base growing fairly quickly. But on the other side, so there's a lot of bullishness. I think then there are two aspects that I'd like to talk about in terms of where there are challenges. One is more regulatory and the second is more market structure. Let me attempt market structure first. It's kind of attuned to the earlier point that I was making, that a lot of the capital is going in very high degree of competition in the top 30-40 cities. So every new dime of capital that's coming in is competing within that same population set, trying to cater to that same population set. So what's ending up happening is that that creates margin pressure for everybody, because everybody kind of undercuts each other. And you've not found models yet to cater to the uncatered population, which has other different cost structure challenges. So somewhere a lot of the capital where I see the private equity being hesitant or finding some challenges is not in the overall growth. It's just that the capital is competing in the same segments over and over again, which makes the return profile probably less lucrative because you end up undercutting each other. So I think that's area. That's where I feel specialist insurers and private equity wants to chase now different models. They don't want to chase the 25th auto insurance company or the 30th health insurance company, which is again trying to cater to probably the same urban segment. So I think margin profile and return profile is bothering them, is what I feel. And newer models are probably not found that footing. That's one on the market structure. Second is more regulatory. I think we are seeing a lot of good movement now on taking away some of the complicated regulations around private equity investments, where they had to set up some special SPVs which had tax implications, and all of that is going away or is likely to go away soon. So at least those regulatory pieces are process pieces are getting easier for them. The regulator, what I do understand, has taken a lot of positive steps in meeting the investors and actually quoting them for the first time, saying, hey, what do we need to do, versus making them, for lack of better words, run through hoops to get into the sector. So now it's more of a red carpet. So all that is great. I think one more thing from a regulatory or a government position that can be done is how do they make it easier for private equity companies to invest more in the specialist companies, to improve penetration, improve coverage, and let that capital cater to a different segment of the population. Again, no easy answers there, but if they could have everything from tax breaks to lower capital requirements, if they were to deploy capital in segments which are untapped or underserved, I think that would be helpful. Last bit on this is I think the government really needs to find an answer for the PSU companies, at least on the general insurance side, because that's the other narrative that we hear from private equity investors. We are competing against the government, who's mispricing in some sense, or is mispriced, or is not as so the private capital is competing against the government, and the government pricing that's been done is probably not very it's hard to support those levels of pricing. So those are some of the structural elements, and on the regulatory side, at the cost of repetition, more SOPs to cater to the underserved would probably help the government, help the penetration, and help private equity have more lucrative options than competing in the top 20 cities again.
Thanks, Varun. That was very interesting, because we are talking about penetration, government action to increase penetration, at the same time, of course, the disbalance of pricing. So the regulator has, in that same light, has announced insurance for all initiative by 2047, the 100th anniversary of our independence. What do you think are the couple of most major reforms required to achieve that?
Few changes that are structurally needed to get to insurance for all or achieve much higher penetration, let's say, than we are there today. One, we're as an industry, this is not in any order, this is whatever comes to mind, but as an industry, we are highly capital inefficient, and I'll give you a case in point. COVID was probably a 1 in a 200 year tragedy, and we were all very solvent as an industry. So on one side it's good, but at this point I can make a controversial statement and say that at this point some insurers should have been under stress, and government should have given them probably some reprieves to be able to manage their capital adequacy. The fact that a 100-year event doesn't even stress anybody's solvency means you're overcapitalized, and that capital could be used for growth. It's just maybe a contrarian way to look at it. Not to say the good part is the companies were strong, balance sheets were strong, but the bad part is for many years you're carrying a lot of capital which is locked away, which could be used for growth. So I think that's on that point itself. We are hearing about a slew of changes that are hopefully coming in, which are more about insurance adding value to people's lives and also generating income for themselves. Again, I'll try and attempt this with a bunch of examples. If I offer you life insurance, and most Indians we're more an emotional race. We don't like to talk about wills and estate planning and and all of these pieces. But a life insurance company offering trust management or will planning services along with is probably a nice organic way to provide those services to those customers at the right moment. Now they need to be able to provide these services, non-risk services, and generate income, which makes more capital efficient structures. And on top of that, customers actually receive value from an insurer on an ongoing basis compared to just at the point of claim. I think today one of the challenges that we face is that customers don't see value, and it's very hard to perceive that value. It's very hard, and I use this example often with my team and with investors and in many conversations. We have BPO employees, forget the rural, right? I'm just saying, lower to middle income, they will take an expensive EMI to afford the latest iPhone, but they will not invest on their health insurance or their life insurance, right? They just don't do it because they don't see that value. So from that value perspective, I think unlocking regulatory reform and saying insurance companies should be able to offer lots of services to show value, because you cannot preach value. If the more you preach, the more distant that value seems, and there's no immediate action on behalf of the consumers. So I think those are a couple of structural changes. They solve many things. They make insurers more relevant in the daily lives of the consumer. They create income streams for insurers so that they can invest more, they can grow more. I think this is one area. Second, I think risk-based solvency is again that hopefully should come in. Maybe it takes a year, maybe it takes 2 years, where today, Acko as a case in point is a completely retail insurer, and we carry the same solvency requirements. We could unlock that capital for a lot more growth, where we are not riding aviation risk or some oil refineries which have much higher risk. So I think risk-based solvency, value-added services, ability to maybe even cross-sell other financial products, because that's when as a brand or as an institution I get relevant to the consumer's lives. And when I do that, I have more hope of penetration rather than saying that I have to somehow provide coverage and the customer is really not seeing value. These 2-3 things, while all under discussion at the regulator, the great part is that they're all under discussion, all under debate, and I think there's recognition now. But how it unfolds, how the actual regulations come in, how companies are able to execute it, we'll have to see. But at least directionally, we as Acko are quite excited that it's going in the right direction.
Yeah, great to hear very positive outlook towards regulations, because that sentiment has been missing in the Indian market. There's a trend that we are seeing of emergence of common platforms, either for claims or for sales, that for people to make show clients, illustrations as well as show rates and conditions. Now, do you think these common platforms for all insurers, which sort of levels the playing field, uh, they will play a big role in either penetration or enrichment of the offerings to the clients?
We've not seen such platforms in the past. If you take India as a case in point, UPI became a common platform for common good or a public good and has really taken off. We've seen something on the lending side also that's worked. We are quite excited as an industry about this platform. It has potentially a lot of benefits, but to me, there's one challenge and then benefits, but overall I think it should all land in the positive box, if I may say so. Challenge with insurance compared to lending or payments, where we've seen public infrastructure or a common infrastructure really create penetration and create awareness, is that the transaction itself is not complex. Payments, peer-to-peer, one-to-one, there's nothing new in the fact that there's inherent virality, there's inherent daily use case in that inherently that structure works, because if I have to pay my panwala or if I have to pay the rickshaw driver, it automatically just happens, right? So but the challenge, even lending, when you go to a little more complex use case, finally what is the cost of the loan, what is the interest rate, and what is the duration of the loan, maybe become 95% of all decision making for consumers, right? What's the interest rate, how much do I have to pay, and whether 3-year loan, 5-year loan, 2-year loan, whatever it is. So there are only 1 or 2 variables to look at. Payment, no variable to look at. Lending, maybe 2 variables to look at. Insurance, there are now too many variables to look at from a consumer standpoint. No 2 policies are the same. You can customize coverages. People's life stages are different. So payments and lending are very standardized use cases. It doesn't matter what your age is, you still want to know the interest and the duration. But as customers go through life, different asset classes, family sizes, the requirements change, and the plethora of products is going to get more and more complicated with easier regulations. With easier regulations on the product side, people are going to come up, or insurance companies are going to come up with more products which are more personalized, more suited to you. That's the direction that product deregulation is going to take us. That's the whole point of it. Now on one side you're going to have a slightly complex use case which needs to be slightly personalized to you, and on the other side you also are trying to standardize everything with a very common platform. So I think the common so there's a little bit of dichotomy in it, because the use cases on payments and lending are far simpler. Having said that for simpler products the dichotomy can be solved. Things for auto insurance, things for very standard life insurance, basic products which you don't have too many frills, or maybe standard coverages for tier 2, tier 3 populations, or low cost coverages. I really think that the platform could create more value, and probably, going back to my point, could be one of the methods to cater to that underserved, large untapped population, because there we are seeing cost of distribution challenges, accessibility challenges, complexity of product explanation challenges. So simple products, government kind of initiated platform. So where I think it will overall land in the positive box is definitely increasing penetration, definitely increasing awareness, which might even mean that creates awareness for specialized products which are probably not bought or serviced on that platform, but it'll still create awareness. So to me, the biggest positive is accessibility to the underserved and awareness. Whether it becomes the only way to transact or probably a majority way to transact, I'm doubtful of that, but all in all should still land in the positive box.
But that's very interesting, because it actually leads to something which has been talked about a lot, Varun. What you were talking about is simplification for penetration, offering for the underserved, really becoming coming up in an avatar that it becomes easy to understand, easy to transact. And you have been doing a lot of that in a different form, probably to a different market, which is embedded insurance being added to what people do in their own daily lives, like buying white goods or buying stuff, as well taking a ride. So taking it to a larger platform, not only the underserved, do you think embedded insurance has a very significant role to play in the coming days?
I think embedded insurance is a good way to trial the product or your first entry point. We use it for customers who are probably not new to insurance but are new to the brand. So when they try out a small product, the cost of trial comes down. We make it a point that those embedded products need to have a claims experience, because that's what builds trust in the brand. So if you have a very low claim product, it really doesn't help, because it's then an attachment which is not yielded that much value to the user. So when we look at it, it was getting customers to try out our brand.
I think that's fundamental, and that probably brings us to relevance. How can insurance industry or insurance be more and more relevant? For example, now there are ESG guidelines all over for all kinds of companies. There are guidelines for insurance also, which you either made many places, many countries, they have come out strongly, like Singapore. But going beyond that, do you think insurance companies can make ESG relevant for all other industrial participants and their constituents and their clients and their customers?
Today, healthcare costs in India, while still affordable compared to the rest of the world, are still quite arbitrary. In terms, and we've all experienced that in COVID, right? Probably the cost could just be anything, and even when we process health claims, we see a lot of costs which are just probably not needed in some sense. So and we've seen globally that governance coming in the payer-provider relationship, when the payers become strong and large, where a lot of medical expense goes through the payers, through the insurance companies rather than out of pocket, it automatically creates a balance in terms of transparency and cost, because now you have institutions trying to keep a check on each other. The market structure gets that balance. Because as an individual consumer, I may not have a voice in terms of, is the hospital doing extra tests or charging me more? I don't even understand it beyond the point. But when institutions come in, what tends to happen is the standardization of costs, standardization of bills, and all of these pieces tend to come in, and you're able to keep the costs low and fair, because the institutions kind of keep a check on each other. Just the nature of the relationship that's defined. So somehow, even pushing this agenda of saying that how do we get insurers to play a larger role in governing healthcare costs. I think Ayushman Bharat is a great step where at least some costs have gotten standardized, because the minute it goes through the payer to the provider, there's automatically the check and balance, and the social responsibility, the governance, and all of that starts to come in institutionally on both sides. I think another area as a company that we've been quite interested in on the environment side is carbon footprint of the cars that we are insuring ourselves, and it's an evil. You have to you need the cars, but can you set off that with insurers really contributing on saying that, hey, a part of what we do can go to in setting off the carbon footprint of the cars that we are insuring, or the kind of fuel that they are consuming. So I think if you look at the data and the size and scale of the insurance industry, whether it is on costs of healthcare or on environmental costs, which may be difficult to quantify, they have data, they have the ecosystem understanding to probably play a part. But I would still say it's very, very early days for the insurance industry. It's really not started looking at it like that. If insurance and FASTag could be used together to reduce waiting time at tolls, or to catch uncompliant people, but all do it automatically, you're saving fuel, in some sense. So you can play a lot of role indirectly in governing costs, in reducing consumption of fuel, in setting off footprint. But I think we're still, as an industry, or maybe most industries, I don't think I should keep blaming the insurance industry, ESG is still at a superficial level, right? People are just ticking the box right now. I don't think it's gone deep within to become culturally aligned.
So let's come to two areas of big challenges in insurance, which we keep hearing from everyone in the industry. One is that this is a complicated product dominated, a lot of selling hustle in the industry. So, and that takes over, and sometimes priorities of being tech first get behind. So that's one. And how do you really stay tech first? And the other one we hear is about the shortage of great talent. How do you attract, retain, manage, really nurture talent in this industry and in your company? Let's be specific to the kind of company that you have created in these two areas.
The first one, at least, which is, it's a complex product, needs the heavy selling, heavy pushing, and which is the truth. But I have a very personally a very different view or a strong opinion on this. And that's what at Acko we are trying to change also. I think our industry has, somehow gotten into this narrative, and I could be wrong, and time may prove me wrong, but at least gotten into this narrative that it needs that complex selling, and I do agree it needs it to a degree, but there are other aspects in a business, right? Your product can be complex, but there is trust, there is brand, there is bunch of other things. This concept that we come from that, hey, it's complex, is because if you provide value to consumers and they feel a certain way about the kind of value that you provide, a lot of the technical stuff can probably not be as important. If you create trust and experience, people will buy the next thing from you. Or now we get stuck in the product complexity. So we look at ourselves as complex product companies versus trust and brand companies. Now this is a very different vector. If you create a trust and brand company, the complexity of the product becomes less of a problem to explain. So we just don't invest enough on the customer experience. The social media is littered with complaints against the Indian insurance industry. It's littered. And I do believe that the intent is not bad. Most of these companies have very high loss ratios and claim ratios, and so, but they're not able to provide that. They're eventually paying, but the process is painful. And the intent is not bad. Investing in that process, investing in that experience, investing in communicating that experience to customers, I think can make a world of a difference. So somewhere I do believe that while assistance may be needed for customers to understand product, that quotient of assistance or the complexity and the effort of assistance comes down if you play up the other vector a little bit. Right now it's too tilted in that complexity vector versus the experience vector, so to speak. And queuing to that is the second point, that is talent, right? So I do find initially it was very difficult for Acko to hire people, given the fact that, like you said right in the beginning of this interview, that's known to be a not glamorous, boring industry. But I do believe that the newer generation of employees that's coming in, probably people who are born in the 90s now, and and who are in the early to mid stage of their career, now starting to get into management positions which are influencing decisions in organizations, at least mid-management positions. They are very attached to doing good things and not just making money, is what we've seen. If they solve for consumers, if consumers feel happy, they make money in the process. We found it very difficult to get this new lot of people to align to policies or product conditions which are not good for consumers. They believe in fairness, they believe in doing right, and job opportunity or making money is just one part of it. So I think culturally, if they want to do right by consumers, and that's the tribe that you get who has that conscience to do it, and we're seeing more and more. And it's a clear divide, right? There's a pragmatic view in the older generation of making money, but the mid generation wants to deliver value. The newer generation wants to deliver value while making money. So if they feel that culture, I think they stick with you. Otherwise, they look at it like a job and they're happy to hop off. So that's at least been where we've seen. So all of it kind of meshes together. If you have that trust and brand vector going, the employees feel for the company, and they don't think their company is trying to pull a fast one on their consumers to make a quick buck. And it all kind of nicely meshes in together. So that's at least the way we've attempted to build it out. And more tactically, we've made sure not to hire from the insurance industry, just to get in a fresh perspective. They learn the domain in 6 months. It's not that hard. So I think we need more people in, we need fresher perspectives in, and the younger generation will solve for doing good. And as companies, we need to develop that culture. More tactically, on the talent front is concerned, I think it strongly believes that technology is going to play a major role. It doesn't matter which industry you're in. So your ability to hire technology folks who want to work in that company needs to be there. Maybe you get obsolete in 5 years or 10 years, but you will get obsolete if your company is not a software company.
Interesting and refreshing as always, Varun, and thank you for being with us.
Thank you so much. Pleasure again. Thank you.